Corporate finance practice problem using Excel. Preferred stock, floating rate. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at a problem with the difference between the straight preferred stock and the floating rate preferred stock. So generally, when we're thinking about preferred stock, we're thinking about kind of that fixed rate. Remember, when we're thinking about the preferred stock as compared to the common stock, one of the benefits being that generally you have to pay the preferred stock before you pay the common stock at some fixed point. But we can imagine a situation or have a situation where we have a floating rate type of preferred stock where the rate could then change as markets change. So what would be the difference here? Well, if we have a straight preferred stock, let's imagine the par value is 100. The yield is at 15% at this point in time. The floating rate preferred stock, we're going to say par value also 100. The yield is at 11%. Now, if we are the investor in the floating rate preferred stock, note that the floating of the rate could actually, be a good thing. And I say actually because many times from an individual standpoint, you might think of a floating rate from the standpoint of a debtor, such as a mortgage or something like that, where you have a fixed rate versus a floating rate. And if the rate goes up in that instance and you're owing money, that could be a bad thing. But if you're the investor and you have a floating rate and the rate possibly goes up, then that could be a good thing because, of course, then hopefully you don't have to do anything at that point in time and the rate could increase along with the increases in the rates on the market. That's why it might be lowering risk to that degree, because obviously if you have a security that will go up automatically if rates go up, then that could lower the risk and therefore the yield might be lower at any given time, but then it could fluctuate. So since the issuance of the securities interest rates have gone up by 2%, so we're going to imagine rates going up by the 2%. So this one is still providing the straight preferred stock, the 15% yield, and this one then could float with regards to the 2%. So what would be the impact on the price? So for the floating preferred stock, we would think that there might not be any impact on the price. That's the point of it floating, meaning we still could have the price at the $100 because the rate would then fluctuate along with the change in the rate here. But the straight one, then we would expect possibly the price to change. So let's say the par value was $100. We're going to say the $100. The yield is going to be the 15%. We had 15% yield. We're then going to say number group, percentify. Let's go to the font group and underline. That's going to give us our annual return, we will say. Annual return equal to the 100 times the 15%. And then we're going to the change in the yield. So we're going to look at the prior yield, which was the 15% again. So we'll pick up that 15%. And then we had that increase. I'm going to go ahead. I'm going to make all of these cells from here on down to here. I'm going to percentify the whole thing by going to the number group and percentify them. There's the 15%. I'm going to say the increase was at the 2%. So we will add the 2%. Underline that by going to the font group and underline. I'm going to indent this annual return just to make it look a little different, possibly better. I hope better. I'm trying to make it look better. So then we have the denominator. The denominator, we'll call this. And let's indent that. Alignment indent. Summing this up equals the SUM of the 15 and the 2. That's going to give us our 17%. Going to underline that by going to the font group and underline. And that's going to give us our price of the stock, which is going to be equal to the 15. There's a negative in there. 15 divided by the 17, 88. Let's add some decimals. Go to the number group, couple decimals, 88.24. Bottom line then, if we have the normal or straight type of preferred stock where we have the interest rate not changing as there's changes in the market, then we could have changes then to the price. Whereas if you're talking about the floating preferred stock, if the rate is going to adjust, then you would think that the price would basically remain the same. The floating is typically a benefit on the investor side of things because, once again, if the interest rates go up and the floating of the investment goes up with it, That's going to allow us less risk on the investment side of things, resulting in possibly having that lower return, but the return fluctuating with the market, which is a benefit.